Perfect. And then, oops.
Okay, thank you.
Cool. All right, we are good to go.
Perfect. And just a casual reminder to for those who aren't presenting to put on themselves on mute, and because you all want to hear about the exciting world of taxes. So let's get started. All right, so let's go with screen 3. And okay, it's doing something a little weird. Forgive me a moment. I am. And it is. Let's do it on this screen for some reason. Either way, I think this will work. Mike, can you see the slides?
We cannot.
Perfect. And is it a full screen or do you see my PowerPoint too?
I just see your face. That's it.
Oh, okay. And let's see here. Oh, here we go. Man, don't I sound like a unprofessional here? Let's go share. All
There
right.
we go.
You see now?
Yeah, it's perfect.
All right, excellent. Apologize for that. Welcome everyone. Here to talk about taxes for the real estate professional, and just a couple of brief introductions. Thanks to Krch Realty and Hughes Private Capital for having me. I've been working on their tax prep and CPA side for probably about 7 years or so. Born in the 51st state, grew up here in the US, and UNR graduate, and I've been doing this for about 15 years, and I've been licensed since 2011, so about 10 years ago. And just a quick disclaimer of what what us bean counters like to always do when we give presentations. The information I give you is going to be very general. It's going to be everyone's tax circumstances are different, so your neighbor or someone else in the kind of shopping line may be talking about their tax situation, and you'd be like, well, that sounds similar to mine. Well, everyone's is a little bit different, so just kind of take that in hand and know that this is general information, and specific circumstances require specific answers. And also at the end, I'm happy to answer questions related to this. So with that out of the way, here's the general topics we're going to be talking about. We're going to be doing a very general overview of taxes, just kind of an abbreviated version. What constitutes a deduction and what kinds of things you can deduct. And it's a very general rule, so I'll go over that. And tracking mileage, that's very important for a lot of trades, but especially everyone here today. Then also reducing your tax burden, more specifically by way of forming a specific kind of entity. That's a very broad topic, so I'm going to touch on it lightly, but it's very helpful information, and I will help each of you. So to look at your tax return, this is of course a very abbreviated version, but pretty much you take your revenue, then less your deductions, and that gives you your taxable income. And then from there, your taxes calculated, then you take away credits and any payments you've made. We're going to be touching on the revenue and deduction side today, and then about a little later on, we're going to talk about the tax side. Credits and payments, we're not really going to talk about, and whether there's anything due or refund, we're not really going to talk about that either. So you have a couple ways to reduce taxes. You can either decrease the revenue, you can increase deductions, and then you can also decrease taxes by choosing a specific entity type, and we'll touch on that a little bit more. But generally, that's how it goes. It's no groundbreaking information for you guys there, but we'll go a little bit deeper into the decreasing revenue side. And pretty much what this means is, for all of you out there, generally you get a 1099, whether it be from Krch, Hughes, or some other kind of entity. And usually you report taxes based on when you actually receive the money. That is, you are a cash basis taxpayer. So you recognize income when you actually receive it. If something is, if you're scheduled to receive something, but you don't get it yet, and you don't get it to the next year, then you don't recognize it, generally speaking. So if you're coming towards year end and you got a big commission coming in and you'd like to maybe push off taxing until the 2022 tax year, then just kind of slow down the process on that and just say, hey, I'd like to receive that next year. That doesn't always work, but it's a good method of deferring the tax bill another year, but still having that cash relatively closely, as far as chronologically talking. One of the other big areas that we're going to be talking about and that Mike asked me to go over specifically was expenses. So increasing your deductions. And some of you may be wondering, well, I'm relatively new to the field. I've been doing this a couple of years, but what is deductible and what can I deduct? And because there's a lot of options out there. And before we jump into that, I want to give like a little bit of tax wisdom, so to speak. And that is only spend something if you really need to. Don't buy a new car because it's a great tax deduction. Get a new car because your old one is breaking down, or you'll substantially reduce your expenses in other ways. So don't spend $1 to save, I mean, in this case, 40 cents, but it could be any dollar amount, really. If you just look at the economics of it, if you shell out $1 out of your pocket, sure, you'll save about 40 cents, but your overall economic situation is going to be down about 60 cents. Whereas if you don't spend anything, you lose out on that 40 cents in tax savings, but you're about 20 cents ahead, or probably more, economic-wise, and that's really what matters. The Internal Revenue Code is really based around the system of economic effect. So if you get money, typically you pay taxes on it. If you pay something deductible, then you get the deduction for it. So pretty much the idea is to find ways to purchase things that you already need, and spend money on something productive. Again, don't buy something just for the sake of the tax deduction. We'll go into what actually is deductible. So this is a very general, by the book explanation of what is deductible. It's pretty much anything that's related to your business. It's ordinary, it's necessary, and reasonable. Well, you may ask, Reed, well, what is ordinary, necessary, and reasonable? And
What?
You are my fun sister.
How are you? I am.
And then as far as going on what is deductible, that is, we talk about what's ordinary, and that's commonly and common and accepted in business.
Oh,
Don't look at the back.
I know you're a mess.
May I remind some folks to put themselves on mute.
Hey, Reed, real quick, you're also able to mute people too as the host.
Oh, okay. Gotcha. I don't present that often, so that's good to know.
Yeah.
So not an angry accountant talking, just me. I just don't know some of these things. So jumping back into this, as far as what's ordinary, it's what's common and accepted in your business. So for instance, mileage, desk fees, retirement contributions, those are advertising, those are very common things in your business. So anything that's normal in the running course of your business that's needed, that's deductible. What's necessary? If you need to set up or prepare a home in advance of someone looking at it, that is a necessary expense. What is reasonable? That is a bit of a gray area, but you just don't want to have any extravagant or lavish expenses or anything like that. So, and these are, and you may say, Reed, that's all well and good, but what are common things that are usually deductible? And these are things, and I can provide this PowerPoint to you later, Michael, if you want to use it later on, or give it to any of your participants. And these are just common things. One of the big items on here is retirement contributions. You always want to think about having money shelled away, even if it's early on. In fact, it's better if you contribute early on in your career to retirement, because the money just grows and grows, and compound effect just has a very a positive effect on your overall economic situation. So these are just common things. One thing we're going to talk about a little bit more is auto and travel, and specifically with regards to tracking mileage. In 2020 and 2021, it wasn't as large of an expense because a lot of people were at home and maybe doing virtual tours and things like that, but you likely still had some. And when it comes to the IRS, they look at, well, what is business use and what is personal use? And then they use that kind of ratio in determining what is the actual deductible mileage amount. So I'll begin by first saying that commuting mileage, that is traveling to the office and back, that is generally personal use, and it's commuting and it's not business. What is typically considered business is you're going out to show homes to clients, you're going to CP seminars, you're going to pick up office supplies, you're going to meet with colleagues to discuss business, things like that. You want to keep track of that. And this is something that the IRS loves to just kind of jump on when they're auditing someone, because the first thing they'll ask for is, well, how do you keep track of your business mileage? Where's your log? And you can have a mileage log in any number of ways. You can have it, the good old fashioned way, pen and paper, just keep it tracked on just a journal in your car. There are advantages to that. One advantage is you don't have to worry about the information getting deleted or missing off of your computer or something like that. The downside is if you actually lose it, that's a big problem. But you can use any one of these methods. The IRS doesn't really care which method you use, just as long as you can prove where you went and why. A second method is electronically. Some of our clients, they go on their calendar in Outlook or elsewhere and they say, okay, I went to XYZ client's house, or I went to pick up supplies here, and then you write down the mileage via there, or electronic notes in any ways. A couple of our realtor clients, they use a phone application. So there's a couple out there. You can use any one. They all work great. MileIQ, TripLog, there's any number of ones. The only thing I really recommend when it comes to tracking mileage is that you have some kind of backup. So electronically, it's relatively easy. You can save that information and save the backup and email it to yourself. Manually, you just want to make sure you don't lose that, or you can scan it, things like that. So, and another important point about mileage tracking is rarely will your business mileage be 100% business. Meaning if you drove, 15,000 miles during the year, it's very unlikely that all those miles were business. If you put them all as business, that's pretty good audit bait. So it's just all the more reason to keep good track of your mileage. And folks typically have questions on this, but I'd be happy to kind of take those later on. And then The next big section is lowering your taxes. And of course, this is a pretty big general topic, but I'm going to talk specifically about, what's involved in your tax bill. So just kind of where we are on the chart right now. And taxes for the real estate professional, especially, it's broken up into two major types. There's income tax, and then there's self-employment tax. Income tax is pretty much what everyone pays on their earnings, whether it's wages, whether it's self-employed earnings, whether it's interest, dividends, things like that. Self-employment tax is something that pertains specifically to those who are running as a sole proprietorship or pretty much making money for themselves. And that's usually anyone who receives a 1099, generally speaking. And this pretty much says the same thing, but self-employment tax, a lot of people are surprised by it. And the reason why is because it's a tax in addition to your regular income tax. And this is 15.3% of your net self-employed earnings. So I'm throwing a lot of terms at you, but I'll show you an example pretty shortly here. And I won't go too deeply into the mechanics, but generally speaking, like at year end, when you're doing your taxes in March, April, you'll get a 1099 that says you made, for instance, 140,000. You'll add up all your expenses. This is including mileage, everything else. And let's say you have 60,000. Then you're allowed a deduction for 1/2 of your self-employment tax. And then I did a little bit of rounding here. So your adjusted gross income, I'm sure a lot of you have filed your own return before. You're familiar with this number, and you take your standard deduction. This assumes you're filing as a single individual, and your taxable income. And so this is where the explanation kind of comes in. You have your regular income tax, which is if you had 62 grand in wages, give or take, then you'd have an income tax bill of about 9,500, give or take, and then you'd be done. But as a self-employed individual, you have this self-employment tax, which kicks in later on. And how this is pretty much calculated is you take the 140,000, you less your business expenses of 60,000, and you multiply that by 15.3%, and you multiply it by this 92% factor here. And this gives you an extra 11 grand in tax. So your total tax bill compared to the regular individual is 20,000 instead of 9,500. And you may say, well, that sounds pretty unfair. Where's all this coming from? Well, when someone is paid wages, if someone was paid wages of, let's just say 80,000, typically the employer withholds Social Security and Medicare taxes. That's 7.65%. Well, where this 15.3% comes in is that you're also paying the employer portion of that. So you're paying both the employee portion and the employer portion, and it adds up, and it's a pretty hefty sum, but there are ways of reducing it. So you notice I have a little asterisk next to here saying this is assuming you don't form an S corporation. And it's just a really helpful entity type. It requires you to set up something with the Secretary of State. And you can either incorporate or set up as an LLC. It doesn't really matter. I won't go into a lot of detail, but I'll just talk about it as a good option. So generally speaking, if you receive a 1099 and you don't do anything with it, you report your earnings on a Schedule C on your tax return, and then you're pretty much done from there. And this is the easiest for the IRS to look at and audit and select you for an audit. One of the things that you want to kind of be mindful of is when you're a sole proprietor, it's easiest for the IRS to select you for audit. I'm not saying that you won't get selected for an audit if you form an LLC or an S corporation, but generally speaking, the IRS publishes statistics saying how often they select folks for audit, and sole proprietors get selected pretty often. So that's available on the IRS website if you want to look at that kind of later. So So do you want to form an entity or do you want to just remain as a sole proprietor? If you just receive a 1099 and you don't do anything else, then you're considered a sole proprietorship and then you pay self-employment tax. If you choose to form an LLC or an S corporation, then you go to the Secretary of State and you file a couple papers that cost a few $100s, and you have to do business a certain way. It's pretty much not the same way as you were doing it before. You have to do a couple more things as far as tracking your minutes, pay yourself wages and things like that. So you notice this arrow that's kind of going across the bottom here. This says, less independent from owners, whereas you're more independent from owners. This pretty much means that as you kind of go towards the business route right here, forming an S corporation or an LLC, the more distance you are from yourself as an individual, and thus you have to change how you do business in other ways. So what I mean by that is you have an actual entity formed, you have a separate bank account, that's important. Pardon that. And you'll want to, if you're an S corporation, you want to pay yourself wages, in which case you'll get a payroll service or other kinds of things. This is a much broader topic, but just ask yourself the question, if you think you're going to have a fair amount of commissions in 2021 or 2022, look at spending the money to set up an S corporation and have these kind of things done, and get help if you don't know how to do them. It will save you a considerable amount of money in the first year, and it will probably pay for itself almost right away. And again, it depends on your facts and circumstances, but that's kind of an important factor. So if you're not earning too much in commissions, then I would say keep it simple, remain as a sole proprietor. If you're gonna be earning substantial commissions, I would say 60,000 or greater, really look at forming an LLC or an S corporation. C corporation, I wouldn't really recommend that much, but and consult someone who's familiar with how to form those. You don't necessarily need to go through an attorney, but you can just form it on the Secretary of State website. But if you're really unsure, then I recommend seeing an attorney. So if you don't do anything, you just say, hey, Reed, I'm just gonna remain as a sole proprietor. You're gonna be paying both regular income tax and self-employment tax. How you get money out of the business will be just draws. You just take money out, and if you're an S corporation, you're going to pay yourself wages, but you can also do draws. Another thing to consider, it's a kind of a non-tax factor, is if you're a sole proprietor, you typically have much greater personal liability. If you're an LLC or an S corporation, the LLC stands for limited liability company. So you have a lot less personal liability. The ability for someone to attach to your personal assets if they sue you is a lot less. And same with an S corporation, generally speaking. And if you form an LLC or an S corporation, generally speaking, your audit rates can be less, but again, no one can guarantee that you won't get audited. It's just your exposure is typically a lot less. Something I like to always say in the tax world is it depends on your circumstances. If you're making just 20 grand a year and like next year you're not planning on making too much more, then probably recommend remaining as a sole proprietor. But it's a lot easier to operate. But if you're going to be earning substantially more, then I would recommend the LLC or S corporation route. With that, I'm going to pass it back to Michael to see if there are any questions.
Thanks, Reed.
You bet. Man, let me see if I can pass it back to you. Let's see. There you go. And
So I'll make a statement on that Mile IQ app.
I know I pass it back to you, Chris. So happy to answer any questions.
Go.
We were just saying that, that I use that Mile IQ and it actually just gives me printouts for my CPA at the end of the year. So
Oh,
it
that's
just
cool.
Every time I drive, it keeps track of it, and then like at the end of the week, I just go through and put, you know, swipe left for business, swipe right for personal.
Mm-hmm.
Then after you swipe a couple times, it starts to auto do it for you. So now that towards the end of the year, it's really easy. I just have to do it a few times during the month, and I just do my printouts for my tax cut.
That's awesome.
Yeah, so it's awesome now.
Did everybody on the call hear that?
No.
Mary,
Yeah.
would you like to repeat that? Kind of talk towards that microphone.
Can you guys hear me now?
I can hear you. So I'd give it a narwhal.
All right, well, I was just saying that I use the Mile IQ app and I love it. It tracks everywhere I go, that's as long as my phone's with me. And I just swipe left for anything business and right for anything personal. And then at the end of the year for my taxes, it just puts it in a spreadsheet format so I can email it over to my tax professional. It's really cool.
Yeah, it's something that I've seen in other instances, and it really alleviates the quote unquote pain of tracking mileage, because doing it on paper is just, it's really hard to do. And having that app with you is a great tool. And it doesn't necessarily have to be an electronic method, but it definitely does help. And the IRS will be happy for that. There was something in the chat that talked about making an LLC, and you can use it pretty much from the day you form it all the way to the end of the year, and of course afterwards. But the time before that, you can't say that there was kind of LLC earnings. So it's pretty much from the day of formation forward. One of the helpful points that I didn't touch on as much, pretty much because of time, was because when you form an LLC, just because it's an LLC doesn't mean you can't become an S corporation. You can file a certain IRS form. It's an 8832 that pretty much says, hey, I formed an LLC, but I want it to be taxed as a S corporation. Having an S corporation and doing it properly by paying yourself wages and everything will help a lot. It'll reduce your tax bill considerably. It's something that you generally want a tax professional to do. It doesn't necessarily have to be a CPA, it could be a enrolled agent or anyone else. But it's something that's important to do right, and that you have proof of, like when you actually submitted it. If there's anything that I'd recommend taking away from this presentation, it would be that highly consider forming an LLC if your earnings are going to be substantial, and then look at an S corporation. So any other comments or questions or anything like that?
So I have a question about the mileage. You mentioned going to the office is not included. Now, what about for us that we all work from home and like we're coming here for training? We wouldn't normally be coming here.
Right. That's an excellent question. Back in the day, I'm going to say pre-COVID, generally speaking, people came to the office and they drove from home and they did all their work from there. Now it's really, people have very elaborate home offices set up. They pretty much do everything, and they really only drop by the physical office, whether it be Krch or elsewhere, just to maybe pick up documents or go to meetings, things like that. So if you can establish your home as your kind of home base, then absolutely. Mileage from there is considered business. You just want to be able to substantiate that you do everything from home, and have all kind of like photos to show, hey, this is my home office area. Not have a lot of personal things there. So we have had clients where they've set up their office at home and it's totally legitimate and the IRS says give their nod on it. So to the realtor, that is very much doable. It just really depends on how much you go to the physical office to do business. If you're going there every day, the IRS really may doubt whether your office is truly at home, and it depends on facts and circumstances. But nowadays, especially with COVID and not too many personal meetings and things like that, doing it from home and having the mileage there to and fro, that can be a business mileage expense.
Hey, Reed, quick question. I know there's a big tax benefit to actually creating a home office, but there's some pretty stringent requirements for it to be considered a home office. Could you touch on that?
Yeah, and back in the day, it was kind of before my time. It was kind of, especially in the 90s, the IRS really aggressively pursued people taking the home office deduction. The IRS has kind of come back on that, and they're not as much sticklers about that. So I remember in an IRS audit once back in 07 or something like that, the auditor actually went to the person's home office and they nixed the deduction. We fought it and kind of successfully won, but they nixed the deduction because they had personal pictures set up at their home office. And you can't have generally any personal things there, but as far as like what makes a home office, I mean, for practical purposes, I would just recommend, having your laptop and all your business files and everything set up there, and just generally having an area cordoned off at your home. I mean, are the kids going to be there? Is the dog going to be there? Of course, but it's a lot more easier to substantiate than it used to be. So I wouldn't worry about it as much. Just be prepared to calculate the square footage and ratio to your total home and things like that. But generally speaking, just be mindful that you should do most of your business there and don't do a lot of personal stuff there. It'll put you in a better frame of mind. Does that help?
Yeah, and how much is that home office deduction?
So there are two general methods of calculating the home office deduction. The first one, which is easier to do, but it's also not as beneficial, is the IRS method. Well, it's the IRS simplified method, and you just take the square footage of business usage and multiply it by $5. Obviously, that doesn't allow for too much. So the other method is to calculate the cost of maintaining your home. That is rent or mortgage interest, utilities, insurance, general repairs, things like that. And then you multiply it on a pro rata basis to your overall home. So if, for simplicity's sake, if your home office is 100 square feet and your total home is 1,000 square feet, and the cost of maintaining your home is $15,000, rent and everything else, you pretty much take 10% of that number, and that's your home office deduction.
Awesome, thank you.
You bet. With that, I appreciate everyone's time in listening to a bean counter. I hope I made your tax time a little easier to a little more underwhelming, and I hope that the presentation was a benefit to you guys. So, Mike, thanks for having me, and you guys have yourself a great weekend.
You too. Thank you very much, Reed.
Thank you. Thank you.
My pleasure. Take care, you guys.
Cool. Well, there we are.